Hi everyone, I'm Simran and today I walk you through a full discounting valuation of Tata Motor Passenger Private Limited from 2025, audit financial and our 5-year forward projection through 2030.
So good morning. Today I am walking you through a full discounting cash flow valuation of Tata Motors Passenger Vehicle Limited, build an FN25 audit finance and our 5-year from projection to 2030. This is an investment banking grade model covering revenue build, EBITDA expansion, free cash flow generation, WACC derivation, terminal value and multi-scenarios equity bridge, analytic rating, our conclusion build our 12-month price target of rupees 644, implying an 84% upside from the current market price of rupees 350.50. To be clear, this is not a speculative call. It is anchored in a base case DCF that yield an implied share price rupees 639, sitting right at our target. The market, in our view, is pricing in near terms heading with uh, headwind without giving sufficient credit to JLR media term recovery uh, and India EV market leadership trajectory. Valuation footage field our three scenarios, a wild but an analytical growth range. So first is our dear case of rupees 258 per share, down to 26% of current price. Assume JLR China volume collapse, India PV margin pressure, and no meaningful EBITDA recovery. Base case of rupees 639 per share, up 32%. This is our central thesis. Measure JLR recovery, India EV share gain, the state margin improvement from 9 to 16%. Then the bull case is rupees 1160 per share, up to 218%, assuming JLR Range Rover EV become a global bestseller and Tata leads the India EV market with 18% share. Okay, so coming to the key material at a glance, enterprises value in our base is a case is like 2 lakh 65,000 885, and equity value is like 2 lakh 35,000 crores crores, and WACC is like 13.5% terminal growth rate is like 5.0%. Okay, so coming to the historical finance. Okay, the historical sheet includes the entire model. Tata Motor has navigated an extraordinary volatile decades. Revenue peaked at 4.4 lakh 34,016 crores in 2024, up from the 2 lakh 49,795 crores in 2021. 3 year CAGR in 16.4%. Year 2025 came in at rupees 4,39,695 crores, largely flat YOY, significantly early sign of slightly fertile primary driven by JLR volume softened in China. So profitability, dramatic turnover. So the P&L, a powerful, strong story of a business that was deeply low making and has a structured record. Like from 2020 to 2022, it's like the net losses are like this. Uh, 12,071 crores, then 13,451 crores, and then 11,444 crores. Driven by the COVID disruption, JLR restructure and evaluate finance cost from 2024. The net profit is like uh, 31,000. Uh, is 31,009 900 399, and then EBIT 555,000 57,809 crores at a 13.3% margin. And in 2025 the net profit is 27,830 crores. EBIT is 56,130 56,138 crores, margin slightly compared to 12.8%, reflecting earlier stage challenges. Balance sheet. So, coming to the balance sheet, critical for our DCF net debt has declined sharply from 1 lakh 05 one lakh 780 crores in 2022 to just 30,760 crores in 2000 sorry in 2025, and EBIT is like 56,138, margin slightly compared to the 12.8%, reflecting uh, 30,000 crores in 75. The delivery story is okay. The debit equity ratio has fallen from 3.3x 2022 to 0.6 in 2025. Cash from operations has been consistently strong, 67,915 crores, and in 2024 rupees 63,102 crores in 2005. Okay, so coming to the cash flows. So see, CFO to revenue has the average to 10 to 15% over the last 3 years, half mark of operating qualitative. This is not a company that manufacturing according profit. The cash conversion is real. So coming to the third sheet. So assumptions. It's okay. So philosophically, every input is source. Every blue cell in this model, every hard-coded assumption is source. Nothing is arbitrary. Let me walk through each level. Section 1, revenue growth rate. So in 2026, it's like 20 is 5% minus 5%. The reflect to concurrent price JLR volume soften in China as a Tesla and BYD gained shares, and India PV market headwind from the EV transition and inventory normalization. This is not a pessimistic. It what the quarterly data shows. Okay, in 2027 sorry to 2030, it's like the project recovery trajectory 18, 12, 12 and 10%. Okay, the recovery is driven by JLR new project cycle, the defense EV range rover PHEV, and India structured EV growth. The long run 10% and grow reflects India automobile CAGR plus JLR premium positioning. Then coming to the second section, like EV EBITDA margin. So in 2026, 2026 is 9% margin in comparison to GLR carries like evaluated launch cost and India IB structure lose like weight on the profit and loss. And then in 2027 to 2030, gradually, the expansion of to 11.5%, 13.5%, 15%, and 16% margin improve is driven by the operating leverage, fixed costs amortize over higher volume, and JLR pricing power in the premium segment. This structure similarly to how BMW, Mercedes improve margin post to post the 2018 cycle. So coming to the section 3 is talking about DAA, and at section 4 capex, like DA runs at 5.5% of revenue in 2026, declined to 4.8% in 2028 as the JLR platform dis, dip, dip, depreciate on a large asset base. Capex is evaluated at 7.5% in year 2026 to 2027. This is the peak of the EV platform investment cycle, then steps down to 6.5% in 2000 in 2030. 2030 maintaining capex dominate. Then coming to the WACC derivations built from first principle. So this is not most technical critical section. Our WACC to 13.55% derives as 13.5%. So risk free return is like 7%. So India 10% G section yield as April 2026 source RBI Bloomberg. Then beta is 1.10%. 1.10%. Tata Motors 5 years monthly beta versus uh, Nifty 50 source Bloomberg terminal, and then equity risk is 8%. So like demo rents India ERP January 2026 estimate, like cost of equity 18.2% derivated as RF plus beta into ERP equal to 7.0% plus 1.04 into 8%. 0%. So after tax cost debt 5.625 in 2025. So financial cost of rupees 5,008 crores over borrowing to 71,542 crores adjusted for a 25% extra rate. Capital structure 63% equity, 37% debt based on current market capitalization of the WACC is 18.2% into 63% plus like 5.625 into 37%. The answer will come like 13.5%. Okay, so terminal growth rate. So we use 5% in the base case. Prior to the India long-term normalized GDP growth rate is like 6 to 7% with a discount for the executive risk. This is our conservative relative India structural growth outlook. Okay, so coming to the fourth sheet, it's about projection. So in projection, we first talk about revenue build. So in 2026, It's rupees 4,16,000 17,710 rupees, reflect the rate 5% conservative assumption, this one. And 2027 it's like 4,51,127% crores recovery, bring 8% growth. In 2028 is like 5,262 crores, 12% as a JLR volume normalized and a India EV scale. Then coming to 2029, it's like 5,65,894 crores, and in 2030 is like 6 lakh to 22,483 crores, the terminal year underpinning our golden growth model. Okay, so coming to the EBITA and EBIT. So EBITA expansion from 37 37,594 crores in year 2006, 27 in rupees 29,095 99,594 crores by the 2030, a near tripling over 5 years after D and A EBIT rise from rupees 14,620 crores to 69,780 crores NOP. Our tax adjustment operating profit goes from 10,965 to 52,000 to 89, from like here to here. Okay, then coming to the FCFF water wall, the economic. The economic engine. Okay, so free cash flow to the firm is calculating as an OPD plus D and A cap change in working capital. Let me walk through the logic from 2026. From 2026, it show 5,908 crores noted become heavy 31,032 crores dominating despite DNN for add back to 22,974 crores working capital release 3,298 crores revenue contract cash benefit in the drawn year. In 2000 in 2027 it's like 5,700 crores. So WACC now absorb rupees 5,013 crores as a growth assumption. Okay, and resume offer NOPT improvement in 2028 to 2030. FFCs like accelerated strongly to 13,732 to 21,746 and 33,280 crores. This is the value creation flywheel. The 2030 terminal FFCC of 33.218 crores is the key input of our terminal value calculated. Then coming to the fifth sheet, DSF evaluation. So WACC confirmed. WACC is like 13.55%. Terminal growth rate is like 0.5 5%. It's like 5%. They are the two most sensitive input in any DCF, and we have a stress tested both um, ex extensively, as you will see in this the sensitive set. Step 2 and 3, the PV of free cash flow. Each FCFF is discounted using the factor 1 divided by to the power n, where n is the year number. The discount factor range from 0.881% one in year to 0.530 in 5 years. The sum of present of the value of FSCC in 2016-2030 amount approx is like 49,687 crores. This represent only 18.7% of our total enterprise volume. The majority of volume sits in the terminal period, which structure consistent for a high growth emerging market company. Then coming to the fourth step, using the uh, Gordon growth model, terminal volume equity FCFF into 1 plus TGR divided by WACC minus TGR. Terminal value is like 33.218 crores into 1.05, then slash 13.55% minus 0.5, and equal to, it will come like 13.218 into 1.05 and slash 8.55. So the answer will come like 4 lakh 8,000 crores. Okay, so this will be calculated, and this answer will come. Okay. Okay. Okay, so discounting back by year at WACC PV of terminal value approx rupees 2,16,198 crores. This discounting constituting 81.3% of total enterprise value, entirely in the line with the comparable emerging market auditing automotive DCF. Then coming to the fifth and the last one step from this. So, enterprise equity. Enterprise to equity bridge. Okay, so enterprises volume like a PV of FCFF plus PV of terminal value. So though it will come like 2,65,000 crores. Okay, and the less net debt of rupees 30,706 crores, 25 2025 borrowing of rupees 71,054 CR minus 40,834 CR. Equity value become like 2,96,000 sorry 2,35,000 179 crores, and divided by 368, it will come like 13 crore share output. So coming to the next slide, next sheet. So the sensitive analysis. So table 1. Okay, so we have a model 75 combined of a WACC against terminal growth. This is the most critical sensitive table DCF. Key observations are like at the WACC the 13%, 13.5%, and the TGR is like 5%, Our base case is implementing price rupees 810, slightly above our around rupees 639 above the uh, rounding in this scenario sheet. Okay. Even at the WSCC, 16% and TARG is like 3.5%. 16%, 3.5. 3% is green, meaning they still implies upside version of the current rupees 35.50. The current market price is of rupees 35 30 50 350 50.50 is only replicated in the bottom left corner to sensitivity table. Combination that implies a worst case scenario. This asymmetric risk profile underpin our buy recommendation. So coming to the second table. So the second table is WACC versus the year 2030 EBITDA margin. So this table is a stress test of our margin assumption even at 12% in year 2030. EBIT margin far below our 16% base. 16% the modern generate rupees 445 per share at our base WACC. At 14% margin we get rupees 682, and at 16 we get 9 14 we get 682, and on 16 we get 9 980, I think. Yeah, 920, I'm sorry. So okay, this mess is the buy cash. The buy case does not require the heroic margin assumption. It requires the business to merely perform at level it has already achieved historically in better year. So coming to the scenario analysis. Okay, so scenario analysis are this. Three structural different outcomes. They are not simple, sensitive. Like each scenario represent a distinct measure and a company trilogy with own WACC and terminal assumption. Base case is like underperformance rupees 258, rupees 258. Sorry, again I will 258 per share key them. The JLR loses market share in China. India PV margin under intense pressure from the Maruti EV and Hyundai create EV high depth service revenue at -8% of 2016, and recovery to the just 8% is 2013. 2000 2013 peak at 50%, WCC at 16%. 16%. 60% TARG is like 3.5%, or in 2030 FCFF rupees 2,360 crores. Equity value is like 95,061 61 crores, and rupees 258 per share at 26%. So base case of rupees 638 per share. Key Key theme, JLR stable in a North American and Europe. China volume reduced but offset by the Middle East, Africa and India. Range Rover PH, case defense, case defense, Middle East, Africa, India, and Range Rover the defense of 2027 2008. India is Tata. If we maintain like 12 to 13%, EV markets shares debt reduction continue. WSEC 13.5% target is like 5%, and in 2013 FCFF of 33,217 crores in enterprises volume 2 lakh 65,885 crores in prices 638. Bull case is strong rupees 1%. 1% key theme Range Rover key. Okay, sorry. Key theme Range Rover EV become a global bestseller, competing with the Porsche Style EV and BMWC. Like India PV Tata leaders the EV market with 18 plus shares. EBIT margin approach JLR historical peak at 18 to 20%. Companies turn net cash by 2028, implying potential like special dividend, but buy back WSCC in 13%. TGR is like 5%. Equity is value of rupees 4,105, like sorry, 4,10,991 crores, and 1,160 per share is 200 upside. Then quarterly validated why the weakness is price. Our quality sheet confirmed that the model assumes assume are not pulled from thin air. Like its 2026 revenue fell to 72,349 crores at 17%, while decline operation loss of rupees 1,040 crores. So question 2 is like revenue 70,108 crores, EBIT barely possibly at 879 crores. They are real headwind, but the investment banking view is that this weakness already view in the stock declined to rupees 350 from prior high creates the entire points as to 2026 and should record as JLR launch new model and India EP volume builds seasonally. So, closing summary, I will tell like to summarize our investment case from the Tata Motors. Passenger Vehicle Limited, the historical business has demonstrate a powerful recovery from best loss near uh, so sorry, I will conclude. I will want to summarize it again. The historical business has a demonstrate a powerful recovery from the deep loss from 2022 to rupees 27,832 crores of net profit in 2025. Near-term headwind JLR China weak India EV transition costs are real but cyclically are and already reflected in the current stock price. Our base case DCF using a recent division WACC of 13.55% and 5% terminal growth rate. Yield and equity volume implying rupees 639 at per share 32% above current market. Sensitivity analysis show the stock only fails to outflow in extreme bear within bear scenarios. The risk review are systematic. The downside scenario still leave the stock with 26% of the current price, while the upside scenario are multiple of current price. So like rating buy from 12 months price target rupees 60 644 current, and current price is like 350.50. We are happy. Okay, so yeah, this is my whole assumption and my explanation. So thank you.